For years, you were told there was a ceiling. You were told there was a limit. You were told that silver had rules, boundaries, and a long, boring history of disappointing anyone bold enough to believe it could ever truly break free. Triple-digit silver, they said, belonged in the same category as flying cars and balanced government budgets. Nice idea, not happening. And yet, here we are. It is still Friday, January 23rd, 2026, and the market has just delivered one of those moments people will later claim they saw coming. Earlier today, we watched silver punch straight through the psychological wall at $99 without hesitation, without ceremony, and without even pretending to slow down. If you thought that was the big moment, the victory lap, the cue to relax and admire the chart, then you're missing the plot. Because this isn't a breakout anymore, this is acceleration. Markets behave very differently once they realize something fundamental has changed. Silver has realized it, the participants have realized it, and the shorts, unfortunately for them, are realizing it far too late. Silver is now trading at $103 per ounce. Say that out loud. Let it register. We didn't tiptoe across $100. We didn't pause to consolidate, didn't offer the market a polite breather, didn't give anyone time to update their models. The price blew straight through the round number like it wasn't even there. In less than 6 hours, silver moved from $99 to $103. That's a $4 move, roughly 4%, in a single session that's supposed to be winding down into a quiet weekend. That is not how healthy, well-behaved markets act. This isn't price discovery by committee. This is what happens when the elevator cable snaps and gravity suddenly works in reverse. Free fall, but upward. What should really get your attention is this. Nothing happened today to justify this move in the traditional sense. No mine shutdown, no surprise embargo, no late afternoon press conference announcing that a central bank had decided to back its currency with silver. There was no new information. What moved the market from $90 to $103 was not news. It was realization. This move is pure momentum, pure fear, pure acknowledgement that the old framework no longer applies. When a market understands that the rules it lived under for decades are gone, it doesn't walk calmly into the future. It sprints. Traders have a polite phrase for this phase. They call it price discovery. That phrase makes it sound orderly, almost academic. In reality, price discovery is chaos with better marketing. It asks what happens when nobody knows what something is worth anymore because all the old anchors have been cut loose. For half a century, silver was anchored in the low 20s, then the low 30s, then the 50s, then the 80s. Each time, the anchor held just long enough to convince everyone that stability had returned, that the system was back under control. And today, the final anchor was ripped clean off the ocean floor. The $90 level wasn't just a number, it was a fortress. It was defended aggressively, persistently, and expensively. And now it's gone. With that anchor removed, silver is floating freely on a current made of liquidity, leverage, and fear. There's nothing underneath it to catch a fall, and nothing above it to impose a ceiling. And this is where the consequences start to get very real, very fast. At $103 silver, industrial users are already in trouble. Solar panel manufacturers, electronics companies, medical device producers, all budgeted for a very different number this year. Their cost structures have just been vaporized. They now have two options: pass those costs on to consumers, or attempt to absorb them and quietly bleed out. Neither option is particularly attractive. Meanwhile, anyone who remained short through the $95 level is now dealing with catastrophic losses. If you shorted silver at $80, expecting a reversion to $70, you are now down $23 per ounce. Multiply that by 10,000 ounces, and you're looking at a $230,000 loss. Scale that up to institutional size, 100 million ounces, and the number becomes 2.3 billion. That's not dramatic language. That's arithmetic. And here's the truly cruel part of the story. Those losses remain theoretical until the position is closed, but to close a short position, you have to buy. You have to go into the market and purchase the metal you promised to deliver. And when you attempt to buy tens or hundreds of millions of ounces in a market that's already moving vertically, your exit becomes fuel. Every attempt to stop the bleeding makes it worse. This is the short squeeze death spiral. There is no graceful way out. The only direction available is up. So when you see silver at $103, don't think of it as a destination. Think of it as a mile marker on a highway where the brakes have failed and the accelerator is jammed to the floor. But the most important part of this story isn't happening in New York. It isn't happening on COMEX or Globex. The real story is unfolding where physical metal actually changes hands, and that place is Shanghai. While Western markets are still trying to process $103, Shanghai has already moved on. The Shanghai Gold Exchange closed today with silver at $123.40 per ounce. Read that number carefully. That's not a glitch. That's not a bad data print. That's the actual closing price on the largest physical precious metals exchange in the world. New York at $103, Shanghai at $123. The spread is now $20.40 per ounce. In a functioning global market, that spread would last seconds. Arbitrage algorithms would buy in New York, sell in Shanghai, and compress the difference almost instantly. That's how the system is supposed to work. But the system isn't working because arbitrage requires something very inconvenient, actual metal. There is no physical silver left in New York to move. The $20 spread is not an opportunity, it's a warning siren. It's the market screaming that the Western price is fiction. It's telling you that the real price, the price at which metal actually changes hands in size, is already north of $120. This has immediate consequences for anyone who thinks they can simply buy silver at the screen price. You can place the order, sure, but what you're buying is not metal. You're buying time. Dealers will quote you $103 and tell you delivery will take 6 to 8 weeks. And when that silver finally arrives, the price will be $130 or $150, and everyone will pretend that was normal. The metal that does exist, the metal available for immediate delivery, is being vacuumed out of Western vaults and shipped east. This is the largest physical transfer of wealth in modern history, happening quietly, efficiently, and without headlines. China is not buying silver because it's trendy. They're buying because they understand what happens next in a currency reset. And when they decide to buy, they don't nibble. The spread isn't stabilizing, it's accelerating. Yesterday it was $12. Today it was $20. Tomorrow it could be $30 or $40. And every dollar it widens increases the urgency to buy now rather than later. Eventually, mathematically, New York has to rise to meet Shanghai. The only question is how long the paper market can maintain the illusion. The answer is not very long. And this isn't isolated. Silver is just the loudest signal. Gold is now trading at $4,987, up more than $50 in a single day. At the same time, the stock market is rising. Bond yields are surging. The 10-year Treasury is at 5.2%. Debt service costs are exploding. The feedback loop is tightening. More interest means more printing. More printing means more inflation. And more inflation means higher asset prices. This isn't prosperity, it's escape velocity. People think they're getting richer because the numbers are bigger. They aren't. They're just holding things that can't be printed while the currency quietly dissolves. Silver was the first to say it out loud. It won't be the last. Most people think progress means moving forward. What they don't notice is that sometimes the floor itself is moving backward. They're running harder, working longer, stacking higher numbers on a screen, and wondering why nothing feels easier. That ink-s because they broke standing on an escalator going down while trying to sprint up the steps. And worse, the level they're trying to stay on is already on fire. This is the wealth illusion. It is the same illusion that has fooled every society that believed it could dilute its money without consequences. The names change, the currencies change, the justifications get more sophisticated, but the pattern never does. Prices rise slowly at first, people shrug, then prices rise faster. People complain, then prices rise exponentially. People panic. And finally, the currency collapses, and money becomes something you move in bulk, not something you count. We're not pushing wheelbarrows yet. Let's be clear about that. But we're long past the "this is temporary" phase. We're in the acceleration phase, and the exponential curve is no longer theoretical. You can see it. The silver market isn't just participating in this shift, it's leading it. It's showing us what happens when enough people reach the same conclusion at the same time and act on it simultaneously. The move from 99s to $103 wasn't the big moment. It was the opening line. It was the clearing of the throat before the speech. What we're rewatching now is the early stage of a repricing that could take months or years as the global financial system adjusts to a reality it's been avoiding for a very long time, a world where the dollar is no longer treated as untouchable. That adjustment will not be smooth. It won't be polite. There will be volatility, confusion, and moments of outright panic. But crises have a funny way of doing something clarity never can. They strip away stories. They expose what has substance and what was held together by belief alone. Real assets stand up. Narratives collapse. And that brings us to something that should feel loud, but strangely doesn't. On a day when silver is surging, gold is pushing toward historic highs, and equities are celebrating like nothing is wrong. One asset is sitting quietly in the corner, pretending not to notice. We need to talk about that silence. We need to talk about Bitcoin. For more than a decade, the story has been beautifully consistent. Digital gold, the future of money, the ultimate hedge against fiat decay. When currencies weaken, Bitcoin rises. When inflation appears, Bitcoin explodes. It's a clean narrative, elegant, easy to repeat. And today, reality took that narrative out back and tested it against the wall. Bitcoin is trading around $87,300 down on the day. Let that settle for a moment. Silver up 4%, gold climbing. Stocks at all-time highs. The so-called everything melt up in full effect. And Bitcoin is red. That's not a rounding error. That's a message. The uncomfortable truth is this. Bitcoin is not money in a crisis. Not yet. It's a speculation on the future. A bet that digital systems will replace physical ones cleanly, smoothly, and without interruption. But that's not the world we're in right now. We're in a world where supply chains fracture, grids get stressed, and trust erodes faster than infrastructure can be repaired. In that world, people don't reach for abstractions. They reach for things they can touch. Silver conducts electricity. Silver kills bacteria. Silver sits inside solar panels, medical equipment, electronics, and water systems. It has 5,000 years of monetary history and a century of industrial necessity behind it. Silver exists whether the Wi-Fi does or not. Bitcoin, by contrast, is code. Brilliant code, revolutionary code. But still code. When the lights go out, code goes dark. When access breaks, digital scarcity becomes theoretical. This isn't a moral judgment on technology. It's a behavioral observation about humans under stress. In good times, people love the future. They chase innovation. They fund disruption. They speculate aggressively. In bad times, they revert. They go back to what worked before the last 5 crises. They trust what their grandparents trusted. And right now, we are not in good times, regardless of what the stock ticker suggests. A $20 spread between Shanghai and New York silver prices is not healthy. Gold rising alongside equities is not normal. These are stress fractures in the system. And when systems fracture, capital doesn't flow toward excitement. It flows toward safety. For most investors globally, safety still means physical assets. Bitcoin's underperformance today isn't a verdict on its long-term potential. It's a snapshot of where we are in the crisis cycle. This is the phase where atoms beat bits, where tangibility wins, where old money reasserts itself before new money gets its turn. That turn may come, but this is not it. There's another factor making Bitcoin stumble, and it's even less comfortable to acknowledge. Despite all the comparisons to gold, Bitcoin trades like a risk asset. It moves with technology stocks. When liquidity is abundant, it thrives. When liquidity tightens, it bleeds. And right now, smart money is rotating away from high beta speculation and toward defense. The stock market's rise is not a sign of strength. It's a symptom of currency weakness. It's a bubble inflated by central bank policy, cheap money, and balance sheets that doubled in size with no exit plan. When that liquidity drains, the assets that benefited most from it will fall the hardest. Silver doesn't need cheap money to justify its value. It needs demand. And demand is coming from 2 directions at once, industry and protection. That combination is rare. Bitcoin's demand, by contrast, is overwhelmingly narrative-driven. People buy it because they expect appreciation, not because they need it to function in the real world. When confidence cracks, that demand can evaporate quickly. We may be witnessing the early stages of that shift. Not the death of digital assets, but a reminder that technological revolutions don't replace history overnight. They overlap, they collide. And in moments of stress, history usually wins. But even that divergence isn't the most important signal today. The real earthquake isn't in metals or crypto or stocks. It's in currencies. The dollar isn't just falling against silver, it's falling against everything. The dollar index has slipped below 95 for the first time in years. It's down more than 2% in a week and over 7% in a month. Those are not gentle moves for the world's reserve currency. Those are warning flares. And yet, there are no emergency meetings, no coordinated interventions, no sense of urgency, just silence. That silence is deafening. The dollar is weakening against the euro, the yen, the pound, the franc, even the yuan. When it falls against everything at once, the issue isn't foreign strength. It's domestic weakness. The cause isn't mysterious. $1 trillion deficits, endless borrowing, and a printing press that never cools. In the last year alone, over $2 trillion were added to the money supply. That's not growth, that's dilution. When you flood the system with units that represent no additional productivity, each unit loses value. This isn't advanced economics, it's arithmetic. And what's changed recently is speed. The dollar's decline is no longer slow erosion. It's acceleration. Currency markets are forward-looking, and what they're pricing in now is a future where restraint never arrives, where debt compounds faster than growth, where the only tool left is more printing. That sets off a feedback loop. Foreign holders sell bonds to escape currency losses. Bond prices fall, yields rise, debt servicing costs explode, more money gets printed, the currency weakens further, more selling follows. That's the doom loop. We're not at the end of it, but we can see the curve bending. This is why silver is at $103. This is why gold is pushing $5,000. This is why stocks rise even as fundamentals decay. Asset prices aren't signaling prosperity. They're signaling escape. You're not getting richer. You're watching numbers inflate while meaning deflates. Every major fiat currency is playing the same game. The difference is balance sheets. And with $38 trillion in debt and deficits that never close, the United States is no longer perceived as the safest player at the table. That perception shift is subtle, but it's real. And capital moves ahead of headlines. This is why Shanghai is paying $123 for silver. This is why physical metal is leaving Western vaults. This is protection, not speculation. And now, slowly, unevenly, the rest of the world is beginning to understand what's happening. That realization is what's driving this market. Not greed, not hype, awareness. And once awareness spreads, it doesn't reverse quietly. At some point, fear stops being emotional and starts becoming logical. That's where we are now. This isn't greed chasing gains anymore. This isn't speculation looking for the next hot trade. What AS driving the market today is something far more powerful and far more dangerous. The realization that the money itself is failing. When people genuinely fear for their financial survival, their behavior changes overnight. They stop planning decades ahead. They stop optimizing portfolios. They stop waiting patiently for perfect entries. They rush. They scramble. They grab whatever they can before the door closes. And that door, whether people want to admit it or not, is starting to swing shut. What we're witnessing right now in silver is not the end of a move. It's the beginning of a panic, a real one, the kind that feeds on itself, the kind that makes yesterday's price look laughably cheap by tomorrow morning. Prices like 103 in New York or 123 in Shanghai are not destinations. They are rest stops, temporary pauses in a process that hasn't even reached full speed yet. The real question isn't whether silver keeps going higher. That question has already been answered by the market. The real question is speed. Does this play out slowly, giving people time to adjust? Or does it accelerate so fast that price levels simply disappear? Based on what we're seeing right now, the broken link between East and West, the disorderly decline of the dollar, the inability of paper markets to keep up, I'm firmly in the fast cascade camp. Fast markets don't behave politely. They don't respect round numbers. They don't give you second chances. They gap. They jump. They skip entire price zones and leave people staring at charts asking how it happened. That's the phase we're entering now. And that brings us to the uncomfortable part. Not theory, not macro philosophy. Action. Silver is over $100. Shanghai is paying well over that. The dollar is rolling downhill with momentum. Stocks are floating higher on printed liquidity. Gold is approaching levels that once sounded insane. Digital assets are wobbling. And you're sitting there asking yourself what, if anything, you're supposed to do next. Here's the reality, stripped of drama. The choice you make in the very near term matters. A lot. Not because the world ends tomorrow, but because trajectories compound faster than human psychology. Waiting feels safe. Waiting feels rational. Waiting feels responsible. And waiting is how people miss every major revaluation in history. The quoted paper price in New York is not the real price. It's a reference point maintained by contracts, leverage, and promises. The real price, the price at which physical metal actually changes hands in size, is being set elsewhere. And right now, that number has a 1, 2, 3 in front of it. That number isn't a ceiling, it's a floor. A floor means sellers are no longer willing to part with their asset below that level. It's a line drawn by reality. Every transaction at that price reinforces it. Every buyer willing to pay that premium is broadcasting a message. This is what it is worth to escape paper currency. And here's the part many people don't want to accept. The lower price does not get to ignore the higher price indefinitely. Either New York rises to meet Shanghai, or Shanghai keeps pulling away until New York becomes irrelevant. We are clearly moving toward the second scenario first. When the physical market fully decouples from the paper market, paper pricing doesn't drift lower, it collapses. And physical pricing doesn't drift higher. It reprices violently. That's how these transitions work. Smooth bridges don't exist in broken systems. If you can acquire physical silver below the physical clearing price, you're not paying a premium. You're buying at a discount, but that window is narrow and it's closing not because supply is gone, though inventories are tight, but because price is moving faster than hesitation. You can place an order at yesterday's price. You just won't receive yesterday's metal. By the time allocations settle, shipments move, and boxes arrive, the number will have changed. That's not manipulation. That's velocity. So what do you actually do? First, you get honest with yourself. How much of your net worth lives in paper promises, cash, bonds, equity exposure? That only works as long as confidence holds. You don't need to panic, but you do need clarity. You can't reposition what you haven't measured. Second, you decide how much exposure to real assets makes sense for you. This isn't a one-size answer. Age, obligations, risk tolerance all matter. But history is clear on one point. During currency stress, paper-heavy portfolios underperform reality. Hard assets don't have to explode in price to win. They just have to survive. Third, you act. You don't wait for perfection. You don't wait for confirmation from analysts who missed the move entirely. You don't wait for a pullback that exists only in hope. In fast markets, the best price is the current one. Tomorrow's price is usually worse. Fourth, and this part matters more than most people realize, you take delivery. Ownership is not a ticker symbol. It's not an ETF share. It's not a certificate. In a stressed system, claims get settled, restructured, or delayed. The only metal you truly own is the metal you can access. Premiums, shipping, storage, those are inconveniences. Losing purchasing power is permanent. Fifth, you prepare yourself mentally. Volatility is not a sign of danger here. It's a feature of repricing. Seeing 10 hours or 15 daily moves will feel uncomfortable if you were not ready for it. But discomfort is not risk. Unpreparedness is. Sixth, you tune out the noise. There will be endless commentary calling this a bubble, a blow-off, a temporary spike. Most of it will be based on chart patterns and indicators designed for normal markets. This is not a normal market. Fundamentals are driving price, not sentiment oscillators. Finally, and this is the hardest step, you hold. Not forever, not blindly, but long enough to exchange silver for something real when it actually matters. Land, a business, productive assets. You don't trade hard money back into dying currency unless you have to. Preservation requires patience. This isn't about being clever. It's about being early enough. And yes, there will always be people who say this all sounds exaggerated, that it's dramatic, that it's fear-driven. They're entitled to their opinions. But facts don't need agreement. Silver is multiples higher than it was years ago. Gold has quadrupled over the long arc. Debt has exploded. Money supply has ballooned. Currency purchasing power has eroded steadily, then suddenly. These are numbers, not narratives. The real illusion was stability. The real fiction was believing that endless printing had no cost. That markets could be suppressed indefinitely. That debt could compound without consequence. That illusion is gone now. What we're living through is not the end of the world. It's the end of a monetary era. Those happen rarely, and they're never gentle. The old system doesn't step aside gracefully. It cracks. It strains. It breaks. Normal isn't coming back. Normal depended on restraint that no longer exists. Normal died the moment printing replaced policy. It died when debt exceeded credibility. It died when physical prices and paper prices stopped agreeing with each other. Silver above $100 isn't expensive. It's honest. It's what an ounce costs when money is abundant and trust is scarce. And honesty in markets is always uncomfortable at first. Prices will keep adjusting, floors will rise, ceilings will remain undefined. The pace may shock people who waited too long. That's how transitions work. You can stand still and hope, or you can reposition and adapt. History tends to reward the second group. This moment will be studied later. The question is simple. Will you remember it as the time you acted, or the time you hesitated? The choice is yours. The clock is moving, and markets don't wait for comfort.